And good afternoon, everyone. My name is Randy Price. He is Matt Price. Welcome to the Price Group. Our topic for this afternoon is the retirement planning timeline, and we hope this will be of value to you. If you're retired or looking to retire, we have some information here that we feel like will be useful for you. As you have questions, you might type those in. And we'll try to answer those as we get toward the end of the seminar. Our goal is 35-40 minutes with some time for questions. Make good use of your time on Tuesday afternoon. Who are we? Again, we're the Price Group, family owned and operated, 45 plus years of experience. I think the key thing here is we are fiduciaries, and we think that is a really important thing as we talk to folks. And retirement is exactly what we do. Our clients are either retired or within 5 years of retirement. Over 82% of our clients fall into that. And we think that is a specialty, just as many things in medicine or law or specialties. Our specialty in the world of wealth management is retirement.
So a little bit more about our team. Randy and I both are certified financial planners. We think credentials really matter in our business. We also went to Wharton to get our CIMA, Certified Investment Management Analyst designation. So something we keep up with, a lot of continuing education there, and a number of years studying to get both those designations. Randy's too humble, so I'll brag on his behalf. He's been nominated by Barron's, Forbes, Financial Times to get a number of awards, typically 1, maybe 2 awards a year. And if you're not following along, we're happy to add you, but we'll put out blogs, that Wealth Coach podcast icon there. We try to create a lot of content for clients and those following to keep everyone educated and try to make it interesting when possible. So a little bit about our firm, Steward Partners, based off the biblical definition of stewardship. Like Randy mentioned, we serve as a fiduciary. We think that is very, very, did I say very important? Not some small little shop that no one's ever heard of. I think we have 32, 33 offices across the country, $24+ billion in client assets. Employee owned, which we think is also critically important. Raymond James is only one of our custodial options. There are a few others, but most all our clients are on the Raymond James platform. So they serve as an extension of our back office. We've been very pleased to work with them over the past 5 years, and very fiscally conservative company, which we think is important from a client perspective.
Thank you, Matt. Okay, today's agenda, as we get right into it. Number 1, let's look at retirement planning if you are 2 to 5 years out. Number 2, we're going to take a look if you are getting closer. Let's start with 2 to 5 years out. Number 1, look before you leap. We are big proponents of creating a wealth and an investment plan for retirement. We'll talk a little bit about what we call our family index number, the rate of return that you'll need to be successful in retirement. You'll need to take a close look at your retirement plan contributions, your allocations to your perhaps outside portfolio, your 401k, how much company stock you have. And that leads sort of number 4 is that is consider the consequences that a negative year in the stock market, a year like 2020, for example, that started out to do well, and then all of a sudden COVID showed its ugly face, and look what happened, a black swan event. But what effect could that have on your retirement date and also your standard of living? We think also consider consulting and perhaps hiring a qualified advisor who specializes in retirement planning. Again, we're 2 to 5 years out with this. So a lot of people that come to see us bring a spreadsheet, and we've seen some rather large spreadsheets. I'm not sure how it got printed, but anyway, this is a title of the slide is a spreadsheet adequate for retirement? And we think the answer is no. Let us walk you through why we think this is true. two boxes on the top, two boxes on the bottom. Let's look at the top left box and the the bottom left box. And we've got 10 years and we have a rate of return starting with the top left box. We're going to take a negative 15% rate of return in year one. We're going to have a bunch of boring 7%. And then we're going to finish year 10 with a 29% positive, green is positive rate of return. If you started with $100,000, you have an average rate of 7% return. And at the end of the time period, you've got $188,399. Congratulations. Now let's flip those returns. Let's take the positive green 29% in year one. Let's put the sevens in the middle, just as we did before. At the bottom, let's take the negative 15% and roll the calculator and see what happens. You end up exactly where you were before. And that's the way it's been for most all of your working life. The sequence of returns has no effect on you in the accumulation phase. Now, what happens is when you do retire, you go from an accumulation phase to a distribution phase. So we're going to tweak each of these boxes, top right, by making a withdrawal, and that's a inflation adjusted withdrawal, 3% inflation for each year that you need money. Put food on the table, put gas in the car, pay your insurance, pay medical expenses, etc. And so when you stress the portfolio out by starting with a negative 15%, it actually has not so good results. Between years 9 and 10, actually the portfolio runs dry. And so in this case, you can see the sequence of returns has a dramatic effect when you're in the distribution phase. Now, bottom right, just to finish this up, same math there. We flip the negative year to year 10. We start out with a positive 29% green return in year one, and you end up with $52,749 left. So the moral to this story is your spreadsheet, although it was very, very good while you're in the accumulation phase, is not nearly as valuable, not nearly as good. It's not nearly a decision-making tool for retirement going forward. We'll talk a little bit more about that as we go. We hear a lot of people talking about, well, my investment guy this, my investment guy that. You need much more than just an investment guy. You need a wealth coach. And we talk about holistic planning. That's estate planning, that's tax planning, that's retirement planning. That, of course, takes into account investments, insurance, cash flow. If we had room, we would put short-term goals, medium-term goals, long-term goals, etc. A gentleman that was Warren Buffett's mentor, a guy named Benjamin Graham, said the best way to measure your success in investing is not by whether you're beating the market, the S&P 500, the Dow Jones, the NASDAQ, etc., by whether you've put in place a financial plan, and this is key, a behavioral discipline that's likely to get you where you want to go. And so that's exactly what we're trying to do here. Be a wealth coach, help out, and allow you to get to where you want to go,
So that begs the question, what would a holistic plan look like? We call our holistic plan a live well plan. For clients on the call, you've probably gone through this exercise. We call it that because clients want to live well, but in addition to that, Randy and I were kind of cheeseballs. We couldn't come up with a better name for it. So live well plan, what this includes, we think retirement is not only an event, it's an ongoing process. So this is not something we create, put in the proverbial drawer and never look at again. Whether we're talking to clients about it every phone call, meeting or not, we're updating this behind the scenes for clients. We're essentially tracking, are we ahead of track? Are we behind track? Are we right on track? And we don't think it's a plan if it's not written down. A lot of people say they have a plan in their head, which we'll politely disagree with. But part of this, we're answering the question, how much can we spend? How long will our money last? A lot of clients are interested in leaving an inheritance to the next generation. And this is key. What rate of return do we need in retirement? And so that is what we call our family index number. And this family index number is a personalized rate of return for each family, where we're attempting to take the least amount of risk possible for you to meet your goals and be successful, to get from here to there, here being the first day of retirement, there being the end of retirement, and still having money left over in the bank, if that is the goal. Randy sometimes also, he likes to act like an old Baptist preacher. We think this Live Well plan, this family index number, our goal is to provide the 3 C's: comfort, confidence, and clarity. And we think planning is really one of the key pieces to doing just that. So with that being said, a lot of this stuff in this webinar presentation can seem high level, and hopefully you're not yawning saying, well, I already knew this, I already knew that. We want to at least add a few kind of very tangible ways, ideas for someone 2 to 5 years from retirement that you can take action on now. Here's a Roth IRA contribution, otherwise known as a backdoor Roth. And what you do, this is for anyone that is phased out of making Roth IRA contributions. So once your income reaches a certain threshold, you can no longer do that. A lot of our clients fall into that upper income bracket. So here's how it works. You can put money into a non-deductible IRA, and then the very next day, you make a conversion from that IRA into a Roth account. Let's say you use $6,000. What you would owe taxes on any gain up and above the contribution, or in this case, $6,000. But if we did the conversion from the IRA to the Roth just the very next day, there would be no gain on it. So it's a tax-free exchange. However, the place where you can stub your toe that we need to be careful on is the pro rata rule. So this does not work for any people who have other pre-tax IRA accounts. And how the IRS looks at this rule, there's a salient difference between IRA accounts and 401ks for this specific rule. So 401k being very different here than an IRA, but if you have other pre-tax IRA dollars, you can do this. It's just not as advantageous. So if you have pre-tax 401k dollars, this is still something, and no pre-tax IRA dollars, this is something you could consider. All that to say, we're not CPAs. We don't provide tax advice. Run this by your tax guy or gal, but a great strategy to add monies through the backdoor Roth 2 to 5 years from retirement. And then second idea we wanted to share for those of you in that 2 to 5 years from retirement. This is very similar. I think of it as the first cousin to the backdoor Roth. This is a backdoor Roth 401k contribution. And so about 20% of 401k plans across the country, and that's a statistic I read just earlier this week actually, allow you to add after-tax dollars in addition to the pre-tax or the Roth dollars to the 401k plan. Some plans allow this, some do not. But what you can do is you can take those after-tax contributions, and whether it's upon separation of service, retirement, or an in-service distribution, you're able to roll the contributions of the after-tax bucket into a Roth IRA. So this is another way to supercharge the Roth IRA savings while you are still working. So once again, we're not tax advisors. If you have any specific questions about those ideas, please let us know by email or a phone call. Happy to walk through them with your personal situation. Here's a look at evaluating the risk, the investment risk budget that you have, once again, 2 to 5 years before retirement. And we posed the question, would a 25% stock market correction delay your retirement? Sometimes the answer is yes, sometimes the answer is no. What we're looking at here in this image is from 2000 to the end of 2014. And the purple line represents the stock market or the S&P 500. And then the top of the green portion or the green line represents 50% moves to the upside of what the market does, but also 50% moves to the downside. And during this 15-year period, what you'll find is the person who took less risk or just had less bumps along the way, they ended up in a much better position than just owning the overall market. Our point is, we think this is the type of philosophy or mindset you should start to adopt leading up until retirement. You've probably been in this go, save as much as you can. If the market pulls back, it's okay, I'll buy more shares, and that's been great. But we need to start transitioning your thought process and possibly your investment portfolio to be a little more conservative for that next drawdown, just so we don't have to defer retirement by any length of time if that's not your goal.
Again, just to remind you, we're 2 to 5 years out, and one of our other thoughts / recommendations is considering hiring an advisor. Emotions do really matter when you are making investment decisions, and mistakes are obviously perhaps more costly as you do approach retirement. That's because you don't have as many years to make up. The advantage of reducing stress, additional investment options to include alternative investments, individual bonds, and strategies for additional income. What's interesting is the chart on the right. This comes from several sources and has been updated on a regular basis, but the average investor there is in the red. These are the returns from 2001 to 2020 over a 20-year period annualized. And the average investor has underperformed. There's the return for REITs, for high yield bonds, for the unmanaged S&P 500 bonds, your primary residence, and also the rate of inflation. So again, hiring a coach to help you through the time can be a very valuable, helpful, and stress-reducing thing to do. So we now switch from 2 to 5 years out. So you're less than 1 year out. You're looking at the calendar. You got things that you're looking at and planning to do. What are the main things that we would say deserve serious consideration? Estimate your retirement income needs. Sometimes this is very easy if you've been keeping track of this in Quicken or something else all these years. But this doesn't have to be a multi-day, a multi-week process, but looking at what your credit cards are, what you write checks for, some of the things you perhaps are spending cash for, some things you pay daily, some you pay weekly, some you pay monthly, some you pay quarterly, some you pay semi-annually. You catch the drift. You'll take a look at if you're fortunate enough to have a company that is a defined benefit pension plan. Many times you will have a lump sum option as well as the monthly annuity option, and begin to evaluate what those look like. Whether you're under 59.5 or over 59.5 really has a lot to do with the planning tools available. Sitting down with us, we create a retirement income strategy. Where's the money going to come from? Again, perhaps a different strategy for the time under 59.5 versus the time when you're over 59.5. You want to make sure that you've got your eye on, again, if you have a lump sum option, the retirement plan discount rate. The lower the rate, the higher the lump sum. The higher the rate, the lower the lump sum. So a change in when your company does implement a change to higher interest rates can sometimes have a dramatic impact on that. The rule of thumb is 0.25% is equal to about a 2% move in the value of your retirement plan. Value of ordinary income and capital gains tax rates. Again, are we selling assets that live to generate? Are we making distributions from your IRA or maybe a non-qualified plan, et cetera? We come back to a qualified and fiduciary-centric advisor team to help you walk through things like this. It's sort of like building a house. The old joke is, how do you build the perfect house? Well, you build the house and then buy a lot across the street and build it the second or third time. And you learn from the first time you built that house. So Anyway, those are some of our less than 1 year out. We'll talk here as we move forward on income needs and retirement. We've now gotten a whiff of inflation. I can't tell you the number of times somebody has asked me, do you know what eggs cost now? But inflation is a hidden tax. You have 6% inflation. Your cost of living is going to double every 12 years. Income needs during retirement. You've got children. The bank of mom and dad never closes. And nights, weekends, and holidays, are you going to be buying some big ticket items? We've had clients buy motor homes, places in the country, so on and so forth. What's your travel budget look like? But tracking your ongoing fixed and also your variable expenses, and then sometimes gifts to family, gifts to charity. So from looking at that, the rule of thumb is 70–80% of your final salary is sort of what you'd end up spending during retirement.
So a pretty catchy title to this slide, if we may say so ourselves, is 3% the new 4%. And for those of you that may not be familiar, the 4% rule is something that's been talked about in the retirement planning community for decades. The rule went like this, and the chart illustrates here. You start with $500,000. You have a balanced portfolio of stocks and bonds. You can take out 4% of your portfolio, inflation adjusted, and over a 20–30 year period, you will typically have the same, if not more, money left after that period, at the end of that 20 to 30 year period. We think there's some compelling evidence to say 3% could be the new 4%. And what we mean by that is these studies, which were done in the 70s, 80s, and 90s over these rolling periods. Here, this one specifically is from 2000 through the end of 21. Even in these 2 decades, interest rates still currently are lower than they were back in the 70s, the 80s, the 90s, early 2000s. So with that being said, one could say, well, my non-stock or my bond piece of the portfolio will probably yield less than these studies have assumed. And we would agree with that. So the shoe doesn't fit for everyone, but we would say this is something to possibly raise an eyebrow at and study in a little more detail, depending on how old you are when you retire and a number of other factors.
Let's talk a little bit more about your defined benefit pension plan. Again, if you're fortunate enough to have that, what are the advantages and what are the disadvantages of each of your 2 options? Let's first look at the company pension plan. On the pro side, income for life, the company takes the investment risk. On the flip side, there's limited flexibility. If you start out and you get a pension of $3,000 a month, what might seem more than adequate, if you mix in some inflation over a 5, 10, 15, 20, 25, 30 year period, you'll find that money does not nearly stretch as far as it used to. It's diminished by inflation. Company risk, we never count on the company not being there to be behind the pension plan, but that is possible. So if you do decide that the retirement annuity, the company pension, is something that is only available to you, or it's the most palatable to your situation, single and joint life options, period certain options, how long will you live, your health, the health of your spouse are variables that need to be taken into account. Are you going to need some money to make large purchases during retirement? Again, a home, a motor home, etc. And are there any non-company annuity alternatives possible where you could do a little bit of both? On the lump sum side, the pluses are flexibility, leaving a potential inheritance for your heirs, inflation protection, estate planning flexibility. On the flip side there, if you don't have a plan, if you don't have some ability to say no, you could spend through your capital. Questions to really ponder and consider here: do you have an investment process? Is it important for you as mom or dad to leave a potential inheritance for the folks that will follow you. What is your break-even rate of return when you compare the lump sum versus the company pension? Where do interest rates go from here? And what is the outlook for inflation? Again, we've come through a period here where inflation has come from virtually nothing to where inflation is in the news most every day. 359.5 early retirement. You can make a one-time distribution, taxed as ordinary income with no penalty. There is a provision in the law under Code Section 72T where you could take payments over 5 years. The longer of 5 years are age 59.5. There is another code section alternative to sell some company stock. It's what's called net unrealized appreciation. If you're under 59.5, you might borrow to get to 59.5, or you might work a little bit to get to 59.5, or you might sell some after-tax assets. So somebody retiring at 58 could look demonstrably different than someone retiring at 60, 61. And again, we go through that with you to put together a plan. The plan's on paper, and it's a roadmap to follow.
Once again, we're in the less than 1 year time frame, and we think it's important at this point to potentially start making some changes to your investment portfolio if you have not already. And one of the things we'll talk about are dividend-paying stocks. For clients on the phone, they know that we're in some ways a one-trick pony. And this is our favorite investment strategy on the stock side. Just from a standpoint, look at the data here. From 1930 through the end of 2021, 40% of the total return meaning dividends plus appreciation of the stock price, came from dividends. So it is a material number. If we can do our job right, what we're doing is we're attempting to isolate the companies that not only pay dividends, but have what we think is a propensity to increase those dividends year over year. So that means a raise during and through retirement from the stock side of your portfolio to combat inflation, like Randy mentioned earlier. But before retirement, we think is the time to consider making a few of these changes.
A lot of people will talk to us about, I can't take a lot of risk in retirement. I need to lock in some fixed income, some bonds, if you will. Let's take a look here at real returns, the return after inflation on Treasury bills, 10-year Treasury bonds over time. And you've got a couple of different periods here. You've got 1928 to 1940, and both did well. You got 1941 to 1960, and both did not do well. Obviously, what happened following the Second World War, there was more inflation out there. And then in 1961, inflation was still going. 1961 to 1980, you had some very benign returns for both as well. And then we hit a golden spot here. Interest rates, if you remember your history, were up around 20% for money market, et cetera. And the period from 1981 to 2000 was a banner year for fixed income because interest rates went down, inflation went down, and so you had some very positive real returns for your Treasury bond, 10-year bond, your Treasury bill, 3-month bond, if you will, on there. And so 2001 to 2022, sort of a mixed bag there, but that's been influenced by some of the rise in interest rates here in the last 12 months. But we can tell you exactly where things were here for 1928 to 2022. But the key is you're most interested. You'd love to have the crystal ball behind door number 2, and that is going forward. So what we see a lot of people need and not have is not only an investment process for stocks, but especially an investment process for their fixed income, because they've not been used to being a fixed income investor over time. So anyway, there you go, a little bit of history of our bond safe over time.
This slide is kind of like we talked about earlier, dividends, and Randy mentioned having an investment process. Here's what it looks like we think investing without an investment process. The grayish line here represents the S&P 500. And what we can do is we can track when people bought or sold mutual funds and ETFs in and out of the market. What you can see at the end of 2002, just a refresher, 2000, 2001, and also 2002 were negative years in the stock market. You see the end of 2002 being the biggest selling point where stocks have been down for 3 consecutive years. People say, I'm out, I've had enough. The second biggest selling point here, early 2009, end of 2008, we all remember stocks being down from peak to trough almost 50%. So with that being said, investing without a process, emotions can take over, and if left to our own emotions, we're statistically not going to make the correct decision. So bottom line, we think you need an investment process. We think you need to develop and create and learn to stick to that process prior to retirement.
So again, why do I need an investment process? How much money can I spend in retirement? How do I invest my portfolio to meet my needs? As Matt briefly touched on, we're big believers in dividend stocks because they pay dividends 4 times a year, and if we've done our job correctly, every once in a while they give you a dividend increase to offset inflation as well. It's been proven by some of the people measuring brain activity that when you get really stressed out, part of your brain that deals in logic doesn't work as well, and emotions get in the way of reason. We think discipline is a key attribute, a key discipline is a key thing to have. Income generation, again, is another core principle of our process-driven investment strategy, and the goal: preserve assets and generate the income that you need to meet your objectives with confidence.
So let's talk for a few minutes about planning after retirement. There still are some things to do, we think, post-retirement. Here's the first one: stress test the portfolio. This is part of the Live Well plan. And the tan or khaki colored box there, I would think logic would tell me, or intuition would tell me, if I'm down 20%, like in a 2022 type of environment, I need 20% to get back to break even. Well, that's not exactly true. What we're looking at here, if you're down 20%, you're taking out 4% from your portfolio, and you have 3% inflation, you actually need 36% just to get back to break even. So we talked about earlier, taking less risk in retirement is important. This is an example of why that is. The hurdles to get back to break even are a lot more palatable when you don't have big downdrafts within your portfolio. So stress testing your portfolio is something we do recommend periodically. That also has to do with that family index number we develop for each client.
So a few planning ideas for consideration: hold assets generating income in your IRA, your qualified accounts. If you're not familiar with how to give money out of your IRA, if you're age 70 or older, it's best thing since sliced bread as far as saving on some taxes, since a lot of people do not get the ability to itemize their deductions based on the cutback in property tax, and also the limit on some of the limits of the higher standard deduction, etc., passed as a result of the new tax laws. You can gift appreciated stocks. Where should you take distributions for retirement? We talked about Roth conversions, especially from money that you're not going to need and can push forward for the next generation. Withdrawing IRA assets before your required minimum distribution starts. We think it's an honor or privilege to pay taxes at the 10 and the 12 and perhaps the 22% bracket. And so even if you don't need that money, what about an idea of withdrawing down your IRAs? year in which you must begin IRA distributions used to be 70.5. It's moved to 72. It's now moving to 73. And so, again, from the standpoint of that, a little bit different thinking and a few tweaks based on some of the law changes. That recent law is called the Secure Act 2.0.
So with that being said, we'd be happy to brush the dust off your current Live Well plan. If we haven't created one for you, happy to create a Live Well plan for you and your family. Like we said earlier, comfort, confidence, and clarity are the goals, and there's no cost or obligation for us to do that.
Yeah, we think the planning is our secret sauce. We firmly believe everybody needs a wealth coach, and again, that's what we do. But Matt, questions?
You had a question come in a few minutes ago. Outlook for inflation, and what are your thoughts on fixed income and bonds moving forward? You want to take that one?
Okay, sure. Inflation is indeed the genie that's out of the bottle, and it is affecting everything from the price of eggs at the grocery store to all other goods and services, and people are having a hard time to keep up for that. Inflation has been very high. We think the rate of increase is decreasing, and that we'll get back more to normal times of inflation. Whether the Federal Reserve can get it back to that 2 to 3% remains to be seen. But an interesting thing as we talk about interest rates is the Federal Reserve has raised short-term interest rates, correct? So you look at the one-year Treasury bond at the end of the day this afternoon at 4.91%, yet the 30-year U.S. government bond is 3.72%. So you say, well, Matt, Randy, that doesn't make sense. Why are short-term interest rates much higher than long-term interest rates? And we call this an inverted yield curve. It does occur several times during history, and it's usually a very good indicator that at some point long-term rates are going to move lower. And so the bond market is telling you the expectation for future inflation is lower, and it's not going to stay this high for too long. Typically, the Federal Reserve will raise rates a little bit too much. The economy will slow, the economy will contract, and then they'll have to eat some of those rates and lower them back in order to give us a little bit more economic activity and to grow the economy, to keep the employment high, et cetera. So if there are no more questions, we want to say thank you. We are grateful that you've taken time out of a busy day to join us. Reach out to us, if you will, with comments. That's Maddie, that's Tiffany, myself, Matt, and Melissa. Phone numbers, email address is there. We are the Price Group. We do believe from the bottom of our hearts that everybody needs a wealth coach. And again, we're here if we can help in any way. Have a great rest of the afternoon, and hope to see you next time on one of our wealth podcasts.